So I think obviously everyone will know, and we've been discussing the impact of the general election. Obviously, Labour winning it. I think it's probably a good place to start. So, Alex, would you just like to run through the impact of Labour winning the general election and what we think that the effects will have on the markets?
Yeah, thanks, Stuart, and thanks for that introduction. I think the first thing to say is maybe to go back to when the announcement was a surprise. Well, I think it was a surprise to me that it was going to be in July, maybe not all politicians and etc. But we didn't really see a lot of volatility on the announcement because it was meant to be in the autumn, wasn't it? Let's be honest, and he's brought it forward to July. So we didn't see a lot of volatility on the announcement. We didn't see a lot of volatility on Friday last week. If anything, markets were slightly positive. So when I talk about markets, I'm talking about sterling, UK bond market, and the UK equity market. The FTSE 250, which is more domestic, actually had a slightly better day on Friday. But like you say, Stuart, we're not looking into too much short-term noise here. It's about focus on the medium to long term. But yeah, so the overall market reaction is pretty muted. And I think there's a few reasons for that. One, it was the expected result. The polls were very largely in Labour's camp beforehand. So we haven't had a surprise, but we've seen polls be wrong before in the past. So they got it right this time. So it was the expected result. Markets don't like uncertainty. And I think what this result gives you is a lot of certainty because of the majority that Labour now have and how much of a landslide victory it was for them. And I mean, you touched on it in your opening remarks, Stuart, that we've had, 6 prime ministers and 7 chancellors over the last few years. Let's hope, fingers crossed, that we have a period of at least 5 to 10 years of stability within the UK, which is really important. The UK has lost a lot of credibility on a global scale since 2016 and the Brexit vote. So we're 8 years into that now. And that's really impacted UK asset prices. The UK stock market is very cheap. We all feel the pain when we go on holiday and we're exchanging our currency because sterling's weak. UK gilt market has actually been quite supportive on a global scale. So, let's hope that it's supportive for UK assets in the coming years.
You mentioned sterling being weak there, Alex. That can have a positive impact upon the FTSE because we're looking at the return on the FTSE, the majority, or the FTSE 100 in particular, the majority being from overseas companies and overseas income. So that can actually have a positive effect when sterling is a little bit weaker, can't it?
Yeah, exactly that. So 70% of the earnings, excuse me, that go in the FTSE 100 are derived from overseas. So if you're exchanging that back at a weaker sterling, that actually is positive. And that was probably the biggest thing that took people by surprise on Brexit, because it was sterling that got clattered on the Brexit announcement. And then suddenly the FTSE 100 leapt and everyone was scratching their head because they were saying, oh, the market's going to go down to 5,000. And everyone got it wrong because they completely missed the fact of this currency translation. And it's not just that. We invest globally for portfolios. So when we're buying US stock market, for example, the S&P 500 or specific companies over there, we're buying so in dollars. So when sterling goes down, that actually appreciates those assets as well. So yeah, it's bizarrely, client portfolios have done better from a weaker sterling over the last 8 or so years, or not even 8 years. If you go back to 2008, it was £1 was getting you $2, and they're about 1.30 today. So it's been a big devaluation of sterling over a long period of time, which will be to the benefit of portfolios.
And I think you're correct with regards to Brexit. There has been a lot of bad news, bad press, probably a feeling that it's going to detrimentally hit the UK stock market, which I think it invariably has done. However, someone said to me the other day, and I don't know if you'll agree with this, that who would have thought 3 years ago with COVID, possibly a little bit longer, that the UK would deem to be a safe haven for investors, as opposed to the basket case, and with that uncertainty that you were talking about, investors would tend to shy away from the UK stock market. Would you agree?
Yeah, and I mean, you only need to be reminded of the events of maybe the last fortnight to highlight that as well, in terms of, well, what's going on in France, for one. Macron also caused a snap election, and that's not gone in his favour. And he's losing power to both the left and the right side in France. And they've got a hung parliament over there now. So that's caused a lot of volatility within French assets. So we've got some slides on what were the drivers of the stock markets over the last quarter and year, but the French stock market is now smaller than the London Stock Exchange, the FTSE, because of the effects of what happened in the politics. You saw French government bonds spike because they're concerned that you could have another fiasco like we had with the mini budget. So French assets have been really under pressure, particularly banks. So that's been a good reminder of the political volatility that you can have. And I mean, who knows what's going to happen in November in the US election? But there's certainly a lot of concern about, well, let's just be honest, Joe Biden's health at the moment, and because of the way that he presented in the first debate. So there's definitely a lot of volatility. I think maybe within the US it's slightly different in that it's so many checks and balances in the way within the US kind of electoral system that the president doesn't have as much power as other individuals or compared to his counterparts globally. So yeah, there's definitely been a reminder over the last month or so that politics does matter. And as you say, the UK now looks like it's very much on stable ground. And it's very early days, but I've been impressed with what I've heard from various members of the new Parliament and Keir Starmer over the last few days. The new Chancellor, Rachel Reeves, is touched on a couple of ways to stimulate the UK economy. One has been house building, to get more house building, because there's been a lack of activity. I think their plans are quite ambitious. So we work with David Smith, who's a consultant at Luna, and he's the chief editor at The Times. And we had a chat with him after the vote came in and just got his initial thoughts, and we're sending a piece round on this. But he said, that it is very ambitious in what they're trying to do, but it's positive. It's, the early signs are very positive about house building, but also trying to get more funding in private investment. And they've just announced today potentially a national wealth fund being launched as well. It's early days. But I mean, I think this is the problem, and we're speculating a little bit. We don't have any facts in terms of what is going to be driven, and we won't have a lot of facts until maybe August, September, when it's likely we'll see the first budget come through. So no, it is interesting times, and the UK does seem like it's on firm footing, and we haven't had a mini budget fiasco. I think that's gone out the window for the time being.
I think everyone's been expecting that, haven't they?
Yeah.
Just what's going to come in. I mean, I think it's, without being negative, because we've been very positive, probably for the first time in 3 years since myself started these webinars. But I think the reality is that even with Labour, they are financially constrained. There's not much room for manoeuvre.
Yeah.
Historically, we've got high taxes, the highest level of national debt since the 60s. We've just come out of a recession, albeit a technical recession. But inflation's coming back under control to around the 2%. If we get this growth, will it impact the inflation rates? And also, obviously, we've seen inflation come down to the 2%, but that hasn't had the knock-on effects into interest rates as of yet.
No, it hasn't. So there's a couple of points there that I'll pick up on. I think the first is UK economic growth. You're right. We had a technical recession in the second half of last year, 2 quarters negative growth, but one was minus 0.1%. So it's probably the weakest ever and shortest lived recession that we've ever seen. But technically it is a recession. But over the last quarter, we saw economic growth for the first quarter this year come through, and that was positive 0.7. So you've already seen we're out of recession. So if anything, the economy is coming through and is starting to accelerate. And just to put that 0.7 in context, the UK economy grows by about 2% per annum in normal times. So about 0.5 is what you'd expect. So it's slightly above average in that first quarter. And we're kind of taking back some of that negativity that came in the second half of last year. So the economy is on pretty firm footing. We look at, maybe I'll just share a few slides actually. We also look at purchaser manager indices. I was expecting to go straight onto the US politics, so we'll just have to skip over that one for a sec. So we might come back to that if we have any questions. Oh, can I go back? Yes, I can. We got some giving away all the presentation here. So here on the right-hand side is these purchase manager indices, and you can see here that if the line is above 50, you've got manufacturing and services in the purple and grey, means you're in expansion territory. Manufacturing was in recession last year, you can see that, but it's rebounded significantly. Services is comfortably above 50. We look at these because they give you a really good indication of what's going on with the economy right now. You know, the economic data I was just talking about is for Q1. You know, we've just finished Q2, so we don't really have a lot of up-to-date information on GDP growth. And that's been really the key issue over the last few years. And you can see here, economic growth over the last 2 years has basically been around zero. So we have just been bouncing around. And just on, you mentioned inflation as well. Again, this chart goes back to 2021, so before Russia invaded the Ukraine, and you can see the different components of what drives inflation within the UK. And then, but the reality is, a year or so ago, it was everything that was contributing to inflation. You had service inflation, you had goods inflation, food and alcohol inflation. You obviously had electricity and gas inflation, and then you had fuel inflation as well. And I think it was very difficult, maybe 18 months or so ago, to get very negative because it felt a horrible environment to be in because inflation was running at 11% in the UK. That's extremely high. Whereas, as we touched on, you fast forward 2 years and inflation's back down to the Bank of England target, and you can see what's driven that. So core goods inflation started to come off, food and alcohol started to come off. Then you've had these deflationary forces of electricity and gas and liquid fuels. That's because energy prices were so much higher a year ago and they're lower today. Now, that's the good news. I think slightly bad news is that if you fast forward 3 to 6 months, then the electricity and gas numbers are going to roll out because they're no longer going to be deflationary. So that's going to come out. And we do have quite sticky core services inflation because wage inflation in the UK is quite high. So we're actually, Stuart and I were talking beforehand, we were right earlier on in the year, and no one was really talking about it when we did the first webinar in January, that inflation was going to get back to this Bank of England target of 2% by the summer. Well, that's exactly what happened. So over the coming months, we'd expect inflation to start to tick back up again. Not back to the levels that we've seen in the past, but maybe 2.5%, 3%. And you're right, the one thing that we haven't seen yet is interest rates being cut. Interest rates have been cut in Europe. The ECB cut interest rates last month. You haven't seen an interest rate cut in the US yet. We'd expect that probably to come in September. But closer to home, I think if you hadn't had the general election last month, you probably would have seen interest rates cut by now. And the reason I say that is because the Bank of England members weren't able to talk before the meeting, which they normally do, and give some signals to the market. And they do that to try and prep the market that interest rates are going to be cut in June. But because they couldn't speak, that is probably the reason why they didn't cut, because inflation's back down to target, and I think they really do want to cut. I think there's a rationale and change for it. They can all go around banging the drum saying that they've won the inflationary battle now. I don't think it's particularly down to central bank policy. I think it's just natural gas prices have come down significantly. But I'm a cynic. So we're expecting interest rates to come down in August by 0.25%. The market is pricing in 4 cuts next year as well. Again, at 0.25, probably once a quarter. So that'll take you down to kind of 4% by the end of next year. But the reality is no one's very good at forecasting these things. If you go back to 2021, people weren't expecting interest rates to get to over 5%. And it also is very dependent on what's going on with the economy at the time. If the economy is performing very strongly, as we sort of suggest it is at the moment, economic growth's accelerating, retail sales are improving, you've got high savings ratios. So there is good data coming through for the UK economy, and that might change the mind of the Bank of England about how many cuts they do. But on the flip side, the US and China economic growth is starting to slow. And as we touched on, we're a global stock market, global economy. So if that happens, you'd expect economic growth to slightly slow as well. And you know, if we saw a recession again, you could see interest rates coming down. So you do have to be mindful about what's going on in the world and be willing to change your view at any one time.
Yeah. So, I mean, you mentioned interest rates, and we increasing, and we saw that last year. I think a lot of our clients probably reverted a lot of their cash into higher interest rate cash deposit funds. You know, if you were getting 0.1% in your savings, there's no point moving it if you're going to get 0.12 for 2 bips. There was no reason to. All of a sudden, you were getting 5.5%, 6% on cash deposit rates.
Yeah.
Now, we're starting to see the long-term cash rates come down. And I know one thing that we've been discussing as an alternative to cash is some bond portfolios, government bond portfolios, particularly in the UK. So with interest rates looking as if they're going to come down in the next 12 months, people may be tying their cash in for 12, 18 months, and those fixed terms coming to an end. Would you still say bonds are a good bet? Are they still an option for clients and investors out there at the moment?
Yeah, absolutely. I think there's a couple of reasons why I think bonds are good within portfolios. The first is the tax benefits. So I'll share my screen because this is my, this is my favorite slide. And you're a bit sad when you've got a favorite slide. But so here we go. Just skip through all this. Excuse me a sec. We'll maybe come back to mortgage rates because that's probably linked to it as well. Where have we been? Where we've been? Here we go. So these are the gilts that are all in the market. Gilts are the most liquid investments there is. They settle on a T+1 basis, so we could buy today and it settles tomorrow, or we could sell today and get the assets back tomorrow. So they're incredibly liquid. And as you touched on, Stuart, we've got the most amount of debt outside of wartime. So we do have a lot of gilt issuance at the moment. And most of these bonds were launched when interest rates are low. So if you're looking at the coupons, they are very low, 0.125, 0.25. And the coupon's fixed. So when interest rates go up, that coupon is less attractive. So you can see that the prices here, they're all below 100. So what happens with a gilt is it's issued at £100. It moves through its life and then it matures at 100. And you can see the shorter they are to maturity, the closer they are to 100 because there's more certainty and you're getting your money back sooner. Whereas the further away down here, it's kind of at 87. Now, the return that you're going to get therefore from buying these gilts is a combination of that coupon, but also more so is that price recovering back to £100 when it matures on these dates here. So that gives you this return figure. The brilliant thing, and this is how sad I am, brilliant thing about gilts is that price recovering from say 87 to 100 is completely tax-free from capital gains to an individual if it's in a general investment account. Obviously, that doesn't apply if it's in a pension or an ISA because they're tax-free wrappers anyway. But if you're buying it outside of those wrappers, then it's completely tax-free. And that's different to cash because if you've got cash in a bank and it's not in an ISA and it's not in your pension, then you are taxed at your marginal tax rate. So what we've done is we've looked at the potential returns on offer. So let's just pick the lowest gilt. So what we've done with a number of clients is either we bought a suite of these bonds or we bought one individual bond specific to their requirement of maybe when they need cash back in the future. But even as I said, if they change their mind, these are very liquid investments, so you can take them out at any one time. The only risk you've got with these is the UK government defaults. And I suppose the only risk you've got with money in the bank is if the bank defaults. I think I'd probably say the UK government is safer than any UK bank. But, regardless of that, we don't have any concerns about the banking system at all. So if you take this 2026 bond, which yours in January 2026, you're getting a coupon of 0.125, so not a lot. You can buy it, let's say £94 today, which gives you a return over its life in two and a bit years of 4%. Now, if you're a higher rate taxpayer, you need to be getting over 7% walking into the bank to be able to get an equivalent return. Now, that just isn't available. And as you said, rates are starting to come back down as well. So to us, gilts are still very attractive within the portfolio. The other point that we like for government bonds, and this focuses on US Treasuries, I couldn't get the data for UK, but it will be very similar. And let me just explain this chart. So in the middle, you've got, if yields change, government bond yields change, what your return is going to be. You've got 2-year bonds in grey, you've got 10-year bonds in blue. So if yields don't change, all you get is your interest. Now, what happened in 2021 and 2022 is interest rates were increased significantly and yields increased therefore. So you made big capital losses within your government bond portfolio of around 20%. But that's what's happened. What's going to happen in the future? So as we said, we think interest rates are going to come down. That means yields are likely to come down. And that means that you're going to get a combination of your coupon, but also some of that capital growth coming back, which you saw. It's kind of the flip of what happened in 2022, where you made big losses. You could make some strong gains. Now, all of the bonds that are on the previous slide were very short dated, so 2-year bonds. You can see here in most scenarios, you make good returns from those bonds because they're so close to maturity, you're locking in those returns. On the flip side, and we've been adding some longer bonds within portfolios recently, the longer the bond, the more interest rate sensitive it is. So we like buying government bonds as well within portfolios for diversification purposes. Interest rates do start to tumble. You can make very strong returns from these levels. So it's a bit of a long answer, but for cautious portfolios, for low risk clients that want security, that want safety, you've got an asset class there that's very tax efficient. Within our more diversified balanced portfolios and cautious portfolios, we do have quite a lot of fixed interest at the moment because you're getting a decent yield, but it also means that you're going to get some protection if there's a nasty in the future, and that's what we're trying to build within portfolios at Luna.
Alex, can you do me a favour? Can you just bring up the table of bond yields, please?
Yeah.
Because one of the things that you mentioned before, that these are, sorry, the previous one, the
it's
table
today. There you go. That one.
That one. So what you mentioned before is that anything on the increase in the gross redemption yield is tax-free, free from capital gains tax. We don't know what Labour are going to do. There has been muted in terms of increasing capital gains tax. They have said that they're not going to increase tax for the working man, but they didn't say anything about capital gains. So this might be an alternative for people who are sat there looking for some form of capital gains in a tax efficient environment in terms of the gains that they can get. Would you agree?
Yeah, I mean, you're right. We're speculating. We don't know what they're going to do. They were very, very selective about their wording the other day in terms of what they're looking to do, and capital gains tax wasn't mentioned. We've seen the allowances already change significantly over the last few years, and they've been brought down significantly. So it's an area that's been under attack over the last few years, and it's definitely something that is going to be looked at. And you're right in terms of the government at the moment have got big plans and desires to do things, but they don't have a lot of wiggle room or flexibility to be able to do that because of how indebted we are. So the reality is, sadly, that I'd expect to see some form of tax hikes going up over the coming years. The other one is VAT being applied to private schools as well, which has been mentioned. So that could be another way of just getting a bit more tax receipts coming through. But equally, how do people respond to that? Because that's a big increase on something that's incredibly expensive anyway.
And that bond you were just discussing before, the Treasury bond that finishes in a year and a half, 2026, that can be quite good for people who are expecting to pay some capital gains tax in the self-assessment for in January 2026. And effectively, the equivalent rate you'd have to get in your savings is around 7% if you're a 45% taxpayer, which you're not going to get in the bank at the moment.
Yeah, and we have quite a lot of clients that hold that specific gilt because it's the lowest coupon, so it's the most tax efficient. But for that reason as well, that they've got a tax bill coming next year and they just want to lock it away. And as I mentioned, you don't have to hold it to maturity when you get £100 back. we've spoken to those clients and we said, well, why don't you sell it maybe a week or so before, so you've got the money in your bank account? It's going to be around 99.9. I don't know what it'll be on the day, and don't hold me to that, but it's going to be very close to that, because of that's, it's so close to maturity at that point that you won't maybe get the whole return, but you're going to get somewhere very close to that.
Who'd have thought UK government bonds could be so interesting and sexy?
I know, who thought it, eh?
So you touched on, I mean, we've spoken a lot about the UK, obviously, because of what's happening in the markets and the general election. Do you want to just touch on what we think is happening on a global perspective, particularly with you've mentioned in the previous webinars about the top seven, the fabulous seven over in America.
Yeah.
Obviously jumping 200% in the last 12 months. So do you want to just touch upon how we think America will be driving the markets?
Yeah, so let's start with an economic growth perspective. And I kind of touched on it earlier that economic growth within the UK is starting to reaccelerate, and you're probably seeing something very similar in Europe as well. Whereas, let's go back a bit. Excuse me. This one here. Whereas US and China is starting to slow, and this chart really pulls that through. So on the left-hand side, you can see growth projections. These are from forecasts from Bloomberg economists. So I think that's a pretty good guide. There's a lot of different economists that are putting data towards this. And look at the UK. I mean, it's nothing to be jumping up and down about, but it's expected that growth is going to be accelerating. And there's the same picture within Europe as well. Whereas the US and China, you can see those bars are starting to fall over the last 3 years. Then growth has been slightly weaker. And then we've just got those PMI data on the right-hand side. You see that all countries are expanding at the moment. So, economic growth globally is pretty strong. What's been driving the US economy is two things. The US has got one of the biggest fiscal deficits it's ever had outside of a crisis. So the US government are spending a lot of money at the moment to try and stimulate the economy. And that's been through the CHIPS Act, for example, but there's lots of different policies that they're doing within the US to stimulate the economy. So that's been positive. The other is consumption. Developed markets are driven by consumption, and US consumers have been drawing down savings that they've accumulated through COVID, where the government were literally sending them checks. And that can't go on forever. And the savings rate in the US now is actually quite low. So we'd expect the US to slow anyway, just because of that. What's been driving markets, and I'll just come back to this. Maybe let's just touch on this one. This is the performance of equity markets over last year, because you highlighted a very important point about what's going on with the US. The US stock market's been on fire. The NASDAQ, which is the technology index, is up nearly 1/3 over the last year. The S&P 500 is at 25%. Whereas you look at the other markets, Nikkei's up 10, FTSE's up 13, Europe 12, China's down, Hang Seng about 1% over this 1 year period. And that's been driven by the hype behind artificial intelligence. And let's be honest, it's not hype, it's a reality now. And I do think it's got significant drivers that's going to have a big impact to play over the coming years to come. The problem is that it's brought forward a lot of the expectation into valuations. So when people get excited about things, they make things become more expensive. And this is just chart in the US, and this is the P ratio. So when it's high, it means the valuation is expensive. And when it's low, it means everything's really cheap. What you typically see is the market low during crises. So this is the financial crisis. This was COVID. This is the end of last year when everything was slightly weaker. And the expectations are very low. And what we've done here is we've split this into two different segments. You've got the top 10 in the US, which are Nvidia, Tesla, Microsoft, Apple, Amazon, Alphabet, which is Google, etc. And you can see that's that green line. But then you've got the other 490 companies in the US in that grey line. And to me, the most important thing when you invest in is the price that you pay for something. And when we go back to 2000, there was so much hype about technology and the internet. And that meant that valuations became very, very expensive. And the problem with that is you're buying something expensive and then it delivers, but you're buying it at the wrong price, and that's where you lose money. And I'm not saying we're not at that stage now with the top 10 in the US, but you can see there that it did fall, but then Nvidia over the last quarter has gone through 3 trillion in terms of size, and it's bounced back significantly. And it's not back to the levels it was after COVID when technology saved the world, but it's certainly getting back up to there. So to me, it's always just something to be slightly wary of when you're buying markets at these levels. And on the flip side, where do we find opportunities? I mean, I think I've bored everyone with this a few times, but we want to be buying things that are cheap. So this is the range since 1990. This is the average since 1990, and then the blue diamond is where we are today. You can see the US is at the upper end of being expensive, and things can stay expensive for a long period of time, and they can get more expensive. Of course they can. But the UK, emerging markets, China, and to a certain extent, Europe, Japan's not on here, but Japan's also a kind of average valuations. They look very cheap markets. And, I've been touching about how valuations are cheap for a while in the UK. But it feels over the last quarter, you've seen a lot of announcements which have really highlighted that. So let me just go through a few for you. Shell announced a 3.5 billion share buyback in the quarter. That's incredible. Prudential, the insurer, announced a 2 billion share buyback. The market capitalization of Prudential is 20 billion. They're just buying 10% of their shares back, which was announced on one single day. They think their shares are too cheap. You've seen companies being bid for left, right, and centre. Every day I open my screen, there's a company that's bid for. Britvic, this week, which is being bought by Carswell. Hargreaves Lansdown's been bid for. Anglo American have been bid for. 2 of them are in the FTSE 100. They are massive companies. A couple of years ago, Standard Chartered was getting bid for. You've seen Unilever bid for in the past as well. Unilever are looking to break up part of their business to try and unlock and realise some of the value. So overseas investors, other investors are now realising just how cheap the UK stock market is. And now that we have some political stability, now that we have a cheap currency as well, then you could start to see more and more of this come through. And it's, as I said, it's not just about M&A activity, it's share buybacks which are coming through as well. And there's a lot of positivity around in the UK market as well at the moment, which has been absent for a while.
And share buybacks a great way for shareholders to distribute profits to shareholders without actually being tied into the binding natures of paying dividends out.
Yep.
In fact, diluting it back. And we're seeing that the dividend yield within the FTSE is running at around 3.6%, which is unusual. Well, there's no other markets out there at the moment that are giving that dividend yield at the moment, is it?
Yeah, no, so you've got an attractive yield, you've got a growing yield as well. So the good thing about equities, which I think has been underappreciated maybe over the last couple of years, is that companies work in an inflationary environment. Companies have been passing on price increases. They've been having to increase wages, of course they have, but they've been, on majority of cases, they've been able to pass on the cost of higher raw materials onto their clients because everyone's been seeing it. So you've seen companies actually perform really well in this environment because they work in an inflationary environment. So if they're getting more profits, then they're distributing and growing profits as well at the same time. So yeah, equities are real assets. You want to have real assets in periods of high inflation. Now, as I said, we're obviously through the back of that now, and there's a lot of good news that we've had on inflation. So, I don't want to dwell on that, but that's what's happened. So businesses have been in good shape. Balance sheets are pretty strong. You're looking at companies globally, not just the UK, people haven't taken on a lot of debt. And if they have taken on some debt, they've been doing it so low interest rates and for very long periods of time, which means it's tied in for a long period of time. So we're pretty positive about the health of global stock markets. We're selective. You have to be selective. We are getting a bit more cautious about the top 10 in the US. It feels a bit, I don't know, a bit hypey at the moment to me. Probably not the technical term, but Nvidia, the amount of growth that you're seeing, I think it's up 100% this year alone. It's it's incredible, and it is going to be the driver. It just might have gone a little bit too far, too fast. Excuse me.
So that's great. Well, that's the past, present. And what can our clients expect from their portfolios going forward? Are there any flags out there that we should be concerned about? Are we out of the woods? Is everything going to be hunky dory?
Well, it depends on the level of risk you're willing to take. Excuse me. I think if you're a cautious investor, you're in a pretty good place because, as I touched on, you can get attractive returns from government bonds. If you're willing to take a bit more risk, buy corporate bonds, and you don't have to. These are very well-known businesses that have got strong balance sheets, like I touched on. But you can get 6 or 7% on those bonds at the moment. If you want to take a little bit more risk, you can buy high yield, which is a bit smaller businesses, and get 8 or 9%. So you can get good returns from bonds. And if you're a high risk investor, there's a lot of opportunities. We still see opportunities within investment trusts. That's been really important over the last year. Actually, they were so unloved a year ago, and people kept saying to us, "Why are you buying investment trusts? They're rubbish." And it's like, no, they'll have their day. Be patient. That's exactly what's happened. You've seen them increase in value, and you've seen discounts close, and that's a double whammy to performance, and that's really helped performance over the last year. So there's still opportunities there. And as I said, you have to be selective, but markets aren't expensive. We're in a period of steady, strongish economic growth. It's not negative. You've got lower inflation. You've got Bank of England and central banks that are willing to stimulate. You've got a government that's willing to try and speed up economic growth. So, you can paint a pretty rosy backdrop, which feels uncomfortable as an Englishman, always willing to knock and provide negativity. But look, you're right. We have to be mindful of geopolitical events. They seem to be increasing on a more frequent scale. There is still elections going on globally, which are going to have big impacts. We touched on the US election. That's probably the most noteworthy. And honestly, I think even if you try to predict the election, you still might not get the market reaction correct. And I mean, the best one example of that is Trump. So Trump is ahead in the polls at the moment, and his lead stretched after that first debate. But even if Trump did become president in November and inaugurated next year, then what Trump are you going to get? Are you going to get the pro-growth Trump that loves the stock market, that wants to perform well, that wants to be tweeting every 5 seconds about how much of a great job he's doing? Or are you going to get the aggressor? Are you going to get the aggressor with China, Russia, and really try and stamp out and put his mark again? And both of those could have different market reactions. So even if you got the predict what's going to happen, afterwards you can't predict. And that again, you go back to the point you made right at the beginning, Stuart. That's not the game that we're in. Presidential cycles come and go. They don't tend to have big impacts on the stock market over the long term. What drives companies fundamentally over the long term is their earnings growth, that they're more profitable. And that's what we're focusing on, looking for good quality businesses that can grow regardless of the political and economics backdrop to a certain extent. Good businesses get better.
Good. Thanks, Alex. We've got a couple of questions. I'm conscious of time. I think you've just touched on that. One of the questions that's come in, and please, if anyone's got any other questions, please feel free to use the Q&A button at the bottom. Should we be more concerned about the potential outcome of the US election this year? You did mention the checks and balances. You mentioned Trump. Which Trump are we going to get? Biden, is he fit for governance? So do you want to just touch on the potential outcomes and the effects of the US election?
Yeah, I think the other thing is Biden keeps saying he's going to run, but there is growing pressure in the US that he doesn't. So we might not even see, but it's impossible to make a prediction because we don't know who's going to be running in November. We think it's going to be Biden versus Trump. And let me just just go through maybe this slide, just to bring it home. So this is what the polls are saying at the moment, and you can see Trump took a big jump after the last debate, and Biden actually fell. But it's not just about who's the president; it's also about the Senate and about the House as well. And this is what the probabilities of the market for the White House and Congress are saying at the moment. So presidency, just over 60% to Trump. The Senate looks like it's overwhelmingly going to the Republican Party at the moment at nearly 80%, whereas the House is a little bit closer. So it's very difficult to call. As I said, it will cause short-term volatility. We work with a company called Ned Davis Research, and I think I shared it on the last quarterly call, and apologies, I don't have the slides in here today. But that basically shows how markets perform in a presidential year. And what they've done is they've tracked every presidential cycle since the stock market began. And what you tend to see is a little bit of nervousness in the run up to it. So we're talking about November. So maybe a little bit of weakness in September, October, not a lot, maybe a 1 or 2% drawdown on average historically. But then markets perform better because, as I said right at the outset, and it was linked to the UK election, markets like certainty. Brexit, in a way, was a terrible thing to do from an economic and stock market perspective. But at least after Brexit, the referendum vote that is, you had the certainty of the event, as bizarre as that sounds. So from November, you will have certainty about who's going to be the US president. And I think that will provide some comfort. And then it depends on their policies. As I said, we're speculating about what the UK might do. We're speculating even more about the US because we don't know who's going to be running, and we don't know what their policies are going to be right now. So we'll have to wait and see there. But back to that point again, what drives share prices is what companies are doing. In the short term, it can be impacted by these things, but over the long term, it's driven by these companies growing their earnings and delivering to shareholders.
Another question that's come in, again, on an election, but the UK election. Historically, is a Labour government good for UK investors?
Yeah, that's a good point, actually. So I did see some statistics this week. It was on Monday. Because you can imagine that over the weekend, everyone's been very keen to do some analysis. And obviously, you have to go back to Tony Blair, so 14 years or so ago now, and before that. And the stats showed that the FTSE 250, which is mid companies in the UK, and therefore exposed to more of the UK economy, about 50% of earnings come from the UK economy for the mid 250. Had outperformed versus what's happened from the Conservative government over the last 14 years. So the stats are suggesting that it tends to be a bit more pro-UK, a bit more pro-UK stock market. That being said, the last 14 years have not been normal. As you touched on, Stuart, you've had COVID, you've had a war, you've had high inflation, and yeah, that's really had an impact on mid-cap valuations within the UK. And as I said, the most important thing for any investment is the starting valuation. UK is cheap. Mid and small cap companies in the UK are screamingly cheap. And I touched on some of the FTSE 100 companies been taken over, but there's a hell of a lot in the mid 250 and small cap and AIM that are being taken over. We had a company in the AIM portfolio taken over last month, which was at a significant premium to the share price. The shares are up 40-50% on the day.
Alex, it's worth just touching on, without trying to do a big sales for Luna and your AIM portfolio, but that is one of your portfolios that's done exceedingly well, hasn't it?
It has, against this backdrop that has been tricky for smaller companies. And I think we look at it versus the FTSE AIM All Share, which is the average. And I think since we launched in June 2020, so we've just celebrated our 4th anniversary, the portfolio is up about 25%, whereas the AIM index is flat. So over 4 years, we've outperformed by 25%. We've had a couple of bids. So Hotel Chocolat got taken over by Mars last year. That was at 160% premium. That was a fantastic result for our clients. So we're delighted by that. But the thing with AIM, and we'll say this over and over, is that we do not have the AIM portfolio for performance. As bizarre as that seems, the AIM portfolio is meant to be boring, like me, because the AIM portfolio is there for an inheritance tax purpose. So if you hold an AIM company for 2 years, it's then outside your estate for inheritance tax purposes. And then if something sadly happens to you and you're holding that AIM company when you die, then it's therefore outside of your estate. So it's there from a inheritance tax basis, and you're probably better to speak about that than I am. There are other inheritance tax products out there. But yes, it's there for that. And our approach is to look for dual defensive businesses that are growing, and that's what we look for. And you know, stable margins, etc., good balance sheets. As I said, boring businesses. They're on AIM, mostly on AIM because the owners of these businesses are mostly family run, and they get the tax benefits from being on AIM as well. So Nichols is a good example, which is the company that make Vimto. You know, that's a big family ownership of the shares, and they want to maintain it. Now, there's other companies on there that you'll know. They just happen to list on AIM. So Jet2 is an example. Stuart, I know that you like a gin and tonic. Fever Tree's on there. So
more than one.
More than one. So there's a lot of businesses that you'll know and have heard of that, you know, just happen to be quoted on AIM because of those tax benefits. But that's the important thing as well. Sorry, Stuart, is, you know, we don't know what's going to happen on inheritance tax and AIM companies in the coming months and years. It's the big risk that every budget we get 2 or 3 clients ring up and say, what's going to happen? And this has been going on for 15 years. And then for 15 years, we're saying we don't know what's going to happen. But I think if the government did do something, then it would destroy the AIM market, because a lot of the investors in AIM are in there for these tax benefits. So you'd have the big sellers of these companies in a not very liquid asset class, which would get impacted significantly. And I think everyone's aware that that's the issue. But I've been surprised by things in the past, but we'll see.
And I think it's worth pointing out that ISAs, by definition, have to be held in an individual's name. However, an ISA can invest into an AIM portfolio, which can have some beneficial inheritance tax benefits, that what you were talking about before, Alex. So if anyone's got an AIM portfolio concerned about inheritance tax issues, there are things that we can discuss. If you want to give your advisor, myself, a recall, we can advise and help and assist wherever we possibly can. Alex, there's a question that's come in, and it's around change of legislation, particularly on pensions. So we'll just read it out. It might be more relevant if I answer it. Do we have any concerns, medium or short term, regarding Labour and a new approach to pensions? Firstly, the annual allowance being reduced from £60,000, and secondly, the capped maximum pension savings being reintroduced, and then thirdly, the 25% tax-free cash allowance once you reach your retirement age. I mean, what I would say on that is that Labour have got into power by being able to take the middle ground. If you're a polar on the right, you will still vote Conservative. If you're polar on the left, you will still vote Labour. If you're even further on the right, you might go down Reform. But the way that Labour's won this election is by taking those middle voters, and usually those floating voters are post-40s, possibly looking at how they are going to retirement. Definitely pensions are in the forefront of the mind. The majority of people will vote for what's in their back pocket, and that's both to be able to save tax straight away, but also when they retire, how much income they're going to be able to generate. So I think if Labour were to attack the annual allowance, which it is £60,000, or look at it, the lifetime allowance being reintroduced, which was originally on the plans, but they've said that they're not going to do that, I think it would have a detrimental effect, and it'd be an easy win for the Tories to say that Labour are a party of higher taxes and attacking the middle class. And we all know that £1 million is a lot of money, but there's a lot of people that have £1 million sat in their pensions, or people with near £1 million in their pensions. And to attack that, I do think it would probably be a bit of political suicide. In saying that, we've discussed the burden that we're at the burden of the highest taxes that we've ever been. The government needs to start looking at increasing some form of income coming in, and obviously the easiest way to do that is by increasing taxes. So there could be something, but I do think it would be a bit of political suicide if they started attacking the annual allowance, the lifetime allowance, or the 25%. But that's not to say that they wouldn't do that. And then lastly, there's a question on ESG. So to what extent do we think ESG considerations are driving investors currently? So I don't know if you want to just briefly define what ESG stands for, Alex, and then the importance of driving investors currently at the moment.
Yeah, so ESG is environmental, social, and governance. So a lot of investors have kind of their own views and want to be doing good by the environment or society, and have good governance standards when they're investing. So a good governance standard would be not having the same CEO and a chairman, for example. That's kind of standard practice in the UK, but not necessarily globally. And that's actually why we didn't invest in one business, the Hook Group. So that has been a big driver to markets over the last 5-10 years, and that's been more investors have been keen to talk to us about that because they've got views. And then that's the whole reason we set up Luna, was because we wanted to take individual views into account when building portfolios. And our previous shop thought that everyone should have the same approach, and we disagreed with that. So I think it is important, if you've got views on your individual portfolio and have an input, then that's exactly why we exist. So that's what ESG is. Now let's just think about the events over the last few years. You've had a war in Russia and Ukraine. You saw commodity prices, oil and other commodity prices spike significantly. When they spike, the profits to those businesses, BP, Shell, etc., miners, increase significantly. Most ESG products do not buy those type of assets for obvious reasons. You then think about the ongoing increase in global wars and social unrest. Defence companies have been seeing increasing amount of contract wins. It's interesting, Keir Starmer's gone to NATO this morning, and they're talking about increasing defence budgets. So that only looks like it's going to continue. Again, ESG products will not buy these type of investments. On the flip side, ESG tends to be a little bit more growthy, and solar and wind, etc. And those areas did very well in COVID, but been coming under pressure over the last few years because, again, back to what I mentioned with Nvidia, they got too hyped. Everyone was expecting that you're going to have wind farms everywhere and solar panels everywhere, and we just weren't there yet because it's going to take a long time to roll these out from an infrastructure perspective. And these things are cyclical, and they just got went a bit too far too soon. So ESG investors over the last few years have underperformed a traditional portfolio, I would say, because you've had areas of the market where they can't buy that have done very well in resource-based, commodity-based assets. But then equally, the areas they did hold were maybe a little bit expensive. So, but I don't have a great view on if you should have an ESG portfolio, if you shouldn't have an ESG portfolio. That's down to clients. We offer both. Of course, from an investment perspective, we want to be buying businesses that aren't polluting the environment, that are socially acceptable, that aren't doing bad things, that have good governance standards in place. And regulation over the last few years has increased significantly here. So every time a company reports, they have to say what they're doing from an ESG perspective, and that's positive. And that's only increasing over the course of this year. There's more legislation coming out, which is going to impact us directly, actually, over the coming months and years. So it's something it's not going away. We embrace it, but we're sensible and pragmatic about it. I mean, I'm sorry to anyone this offends, but we buy BP and Shell. We think they're good businesses. People have underinvested in getting oil out of the ground. Demand is not going away in the short term, and to us, that's going to deliver good share prices in the future.
Okay, good, thank you. Well, Alex, thank you for your time today. I'm conscious time and all our attendees that have dialed in. I mean, one thing that, again, we've always discussed, Alex, is having a well-diversified portfolio and constantly rebalancing, because that's where a lot of the return will come, and making sure that your portfolio reflects your attitude to risk, both in terms of your expected return, but also your volatility that any clients are willing to accept. So I would urge all of our clients to, particularly at this moment in time, make sure you have your review with your advisor. If you're with another financial advisor, feel free to give us a call, and we don't mind reassessing risk and volatility, because actually volatility, as I said before, can be your best friend if you take advantage of it, or your worst enemy if you react to it. So thank you everyone for your time today and dialing in. Alex, thank you for presenting and taking time out. The next quarterly investment seminar, I think it's on the 8th of October, where we hope you can join us. If there is anything that you'd like myself and Alex to cover in future webinars, please feel free to email myself or marketing, and we'll try and build that in. Alternatively, feel free to speak to your Pareto advisor. Make sure you're getting your reviews. Make sure that your underlying investments reflect your risk profile and the volatility. So thank you for your time. Again, we're meeting in the next webinars, the 8th of October, and I hope that you'll all have a great summer. Speak to you soon. Thanks, everyone. We'll probably have an autumn statement to have a look at then as well, Stuart. So there you go. Yes. All interesting. Thanks, everyone. Bye now. Bye-bye.